Welcome to the Deep Dive. We're here to pull out the key insights from important sources to help you stay informed. Today, we're jumping into how companies make those big financial strategy decisions, specifically looking at how they're moving past some of the older, maybe more rigid methods. Yeah, the sources we looked at really focus on this idea of real options. It's quite a dynamic way to look at projects, quite different from just a standard net present value or NPV calculation. NPV, it gives you today's value of future cash flows, but it's very fixed. What we want you to get from this deep dive is how to spot these hidden options, understand the value they add, and see how they push managers to be much more active.
That's a great summary. And real options, it's important to say, aren't just financial things you trade, not like stock options. We're talking about the option in a real business sense, the right, but crucially, not the obligation, to make future choices on actual projects. And it's so important because, like you said, traditional NPV can be, a bit static. It doesn't really capture how good managers adapt and react when things change. Real options analysis tries to value that flexibility.
Okay, that makes sense. So the mission for you listening is, by the end of this, you'll understand how this thinking works, how it uncovers value, and leads to, frankly, better and more agile decisions. Let's get into it. Okay, let's start with a scenario. Picture a company, they're weighing up a big expansion project. The operations team runs the numbers, forecasts the cash flows, finance discounts them back at, say, an 11% cost of capital. That's, the return they need to keep investors happy. And the result comes back, an NTV of just $5 million. Now, the executives who are pushing for this project, they're obviously pretty disappointed. $5 million it's not much for a big investment, and they're worried it just won't get the green light. They feel it's worth more.
Exactly. And this is where you need to dig a bit deeper than that first number. So in discussions, it turns out it's not just one single block of investment. It's actually got two phases. Phase one, you invest $600 million up front that brings in $110 million a year for 10 years. Simple enough. But then there's phase two. After 2 years, the company has the choice, it's discretionary, to invest another $300 million. If they do that, the cash flows jump up by $48 million to $158 million a year for the last 8 years.
Okay, so if you just calculate the NPV for phase one and phase two separately and add them up, you actually land right back near that $5 million mark, don't you? Phase one looks okay on its own, maybe $47.8 million positive NTV. But phase two, if you had to do it, looks bad, like negative $43 million NPV. So together, about $4.8 million. Still not great.
But here's the crucial insight. Phase two is discretionary. They don't have to do it. Therefore, the minimum value of the whole project has to be at least the value of phase one alone, right? Which is $47.8 million.
Okay. So just by recognizing you don't have to do the bad part, the floor value jumps from $5 million way up to nearly $48 million.
Precisely. It's acknowledging the flexibility. Now, there's another little nuance here about valuing that future $300 million investment. Usually, you might discount everything at the company's cost of capital, that 11%. Yeah. But the decision to spend that $300 million in 2 years isn't quite as operationally risky as the project's cash flows themselves. So arguably, it's more accurate to discount that specific future payment using a lower risk-free rate, maybe 5%. Think of it like the return on government bonds. This actually lowers the present value cost of making that investment later. It's similar to how the Black-Scholes option pricing model treats the exercise price. It makes the option more valuable today.
That's interesting. So it makes the hurdle lower, in a sense. But okay, how do we actually put a value on this option to do phase two, especially since right now it looks like a negative NPV decision on its own?
Well, remember the fundamental nature of an option. It can't have negative value. 0 is the floor. It gives you the right to do something if it becomes favorable later. So it adds value by providing that flexibility. To quantify it, we can turn to financial modeling, specifically the Black-Scholes option pricing formula. It needs a few inputs. The exercise price, which is our $300 meter future investment, the value of the underlying asset, that's the present value of those extra cash flows phase two would generate, the time we have to decide, which is 2 years, and then volatility, how much uncertainty is there around those future cash flows? Let's assume 0.4, which is quite standard. And finally, that risk-free rate, which we said was 5%.
Okay, so you feed all that into the Black-Scholes model. What does it tell us this flexibility, this option is actually worth?
Running those numbers, the model calculates an option value. It's a call option because it's an option to expand of $24.22 million.
Wow. Okay. So the total value isn't just the $47.8 million from phase one. You add this $24.22 million for the option.
Exactly. $47.8 million plus $24.22 million gives you a total project value of $72.02 million.
That's That's a huge difference, from $5 million initially to over $72 million, just by properly accounting for the flexibility embedded in the project structure.
Really changes the perspective, doesn't it?
Yeah.
And this is a really important caveat. While Black-Scholes gives us that $24.22 million, you have to treat it as indicative. There are quite a few practical challenges in applying these financial option models directly to real-world business decisions. So it's a powerful insight. It shows potential, but it's not, gospel truth down to the last cent.
Right, a valuable indicator, not a precise prediction.
Yeah.
Understood. So, okay, that's one project. How does this real options way of thinking help when managers are juggling a whole portfolio of potential projects? Traditional MPVs seems even less suited there.
Yeah, the traditional approach can be very limiting with a portfolio. Let's say a company has 6 potential independent projects. Under simple MPV rules, maybe Project U has a $5 positive NPV and Project V has a $3 positive NTV. You'd accept those two for a total of $8 Mullers. The other 4, W, X, Y, and Z, maybe they have negative MPVs. So traditional thinking says just reject them. End of story. Very black and white.
Okay, but now let's bring in the options lens. We need to think about timing and flexibility. Maybe some projects have to be decided on right now, others can wait. Let's use an analogy. Say projects U and X are like fruits you have to pick today. U is perfectly wrecked, that $5 NPV, so you pick it. X is rotten, negative NPV, so you leave it on the ground. But projects V, W, Y, and Z, these are different. They're like fruits that are still on the tree. They don't have to be picked now. They might ripen later, maybe become really valuable.
Exactly. And for these projects where you have the option to delay, you can calculate their option value using, again, let's say a 5% risk-free rate. Maybe the calculations show. Project V's option value is $15 million. Project W's is $2 million. Project Y comes in at $10 million. And Project Z has an option value of $3.5 million.
Okay, hold on. Let's compare the outcomes then. Traditional method. Accept U, $5. Accept V, $3 million. Total value captured, $8 million. Options method. Accept U, $5. Reject X, worthless now. But then you hold the options on V, W, Y, and Z, and the total value of those options is, let's see, $15 million plus $2 million plus $10 plus $3.5 million. That's $30.5 million.
That's right.
So the total value isn't $8 million. It's $5 million from you plus $30.5 million from the options. $35.5 million.
It's a dramatically higher potential value, $35.5 million versus $8 million. It highlights how much value resides in that future flexibility. But, and this echoes the earlier point, realizing that $35.5 million requires careful management. It's not automatic. You have to actively manage those options.
Okay, let's dive into that management aspect. Let's go back to our fruit analogy for each delayed project. Project V. This was interesting. It has a positive $3 minimal NTV now, but a much higher $15 option value. So it's like a fruit you could pick now and it would be okay.
But with careful cultivation, maybe some time, it could become a much bigger, better fruit worth $15 million in option terms. The risk, though, is that while you wait, pests might get it. Competitors could move, the market could shift. So you might still decide to exercise it early, pick the $3 Miller fruit now to avoid losing it altogether. It forces a dynamic decision about timing.
Makes sense. What about Project W negative NPV now? Very low $2 meter option value. Sounds like a dud.
Pretty much.
Yeah.
Our analogy here is the small, late developing fruit that's just unlikely to ripen properly. Low volatility, short time horizon. The management takeaway is don't waste too much time or resources on this one. It's unlikely to ever be worth exercising. Focus elsewhere.
Okay. Then Project Y negative NPV currently, but a high option value of $10 million. Why the big potential there?
This is the classic unripe fruit scenario. You can't pick it now, negative NPV, but it's expected to mature well. The high option value comes from having a long time until expiry, maybe 3 years, and high volatility. Lots of uncertainty means potential for big upside swings. This is a project you definitely want to watch and actively nurture.
Right. And finally, Project Z. Also negative NPV, same as Y, but a much lower option value, only $3.5 million. What makes it less promising than Y?
It's another unripe fruit, but maybe the conditions aren't as good. Lower volatility, shorter time to expiry. The chances of it really maturing into something valuable seem lower than for Project Y. There's still a chance it could become profitable, move into the money, but the option analysis suggests it has less upside potential from active management compared to Y.
This breakdown really highlights how this isn't just about calculation, it's about directing management attention, isn't it?
Absolutely. It encourages active management. V needs careful watching for the right time to act. W can probably be ignored. Y and Z need nurturing, but maybe Y deserves more focus because the potential payoff seems higher.
And that nurturing is key. You said projects like fruit need nurturing because otherwise the option value tends to just decay over time.
Yes, generally.
Yeah.
As time passes, the time to maturity shrinks, which reduces option value. Also, the present value of the future investment cost effectively creeps up. So without something positive happening, the option value naturally erodes towards zero. You need either good luck, like an unexpected economic boom boosting all project returns, or proactive, active management. Active management means finding ways to, say, reduce the project's costs or boost its potential revenues, or maybe even shrink the required initial investment. Option valuation helps pinpoint which projects offer the best potential returns on that kind of management effort.
Okay, we've covered single projects, independent portfolios. Now let's get into the really complex stuff, interdependent projects, where one decision directly affects the value or possibility of another. Like with a car manufacturer, right? They don't just launch one car in isolation. Their decisions are all connected.
Exactly. Interdependencies add another layer. One common type is nested options. Think of it as a call option on another call option. So the car maker launches a new saloon model. That success gives them a call option, the right, but not obligation to launch an estate version based on the same platform. And if the estate does well, maybe that creates another call option to launch a 4x4 version of the estate. You see this strategy sometimes, like Skoda did with their Octavia and Superb ranges, building out variations.
Okay, so one builds on the next.
Right. Then you also have related options, which aren't strictly nested one after the other, but are still linked. A manufacturer launches a saloon. That might give them a call option on an estate and a separate call option on an SUV, both potentially using shared engineering or platform elements. Think BMW's 3 Series saloon, and then the related options to launch the X3 SUV or the 3 Series touring estate. They're connected, but maybe pursued in parallel.
Understanding those connections must be critical for planning strategy. It's not just about this car, but the whole family of cars it enables.
Absolutely. And good luck and active management become even more interesting here. For example, good luck. A few really harsh winters could boost demand for SUVs and 4x4s. That increases the value of the call options on those future models, which in turn actually increases the value proposition of launching the initial saloon platform they'd be based on.
So external factors can ripple through the chain.
Definitely. And active management? Let's say the engineers develop a brilliant new fuel-efficient 4x4 system. That makes the potential SUV and 4x4 estate models much more attractive, boosting their option values, and again, making the initial saloon project more valuable because it unlocks those possibilities. Of course, you also have to consider potential cannibalization. Maybe more 4x4 sales mean fewer saloon sales. It's complex.
So when launching that first model, the marketing shouldn't just focus on immediate sales, but also on building the right perception to set up those future options for success.
Precisely. You want to manage perceptions to maximize the chances for the follow-on models. Knowing what drives option value helps here too. For instance, if you see high growth and volatility in the SUV market in, say, China, that makes the option to develop an SE variant particularly valuable. This feeds back and enhances the strategic value of the initial core model launch that enables it. It's all interconnected.
Okay, let's pull this all together then. This deep dive really shows how thinking in terms of real options fundamentally changes how companies should look at and manage their big projects. It's a big leap beyond just static NPV.
It really is. Option valuation helps you see the potential value, not just the calculated value based on today's assumptions. It guides strategy towards maximizing results, maximizing flexibility, and ultimately maximizing the company's overall value. It forces, or rather empowers, active, dynamic management. You're not just executing a fixed plan, you're managing a portfolio of opportunities.
So, a final thought for you, the listener, to take away. Next time you read about a company launching a new product line or making a big strategic investment, try to look deeper. Ask yourself, what are the hidden options here? What future decisions does this move enable? And how might the company be actively managing things now to make those future options more valuable? It definitely adds a new dimension to how you view business strategy.